All right, I'm showing 1 minute past the hour. Well, thanks everyone for joining us here today again, and welcome to Ginkgo REIT's 2025 year-end presentation. We did send a year-end report about a week and a half ago that includes comprehensive and audited financials. But just know that if you missed that email, or it might have gotten lost in your inbox, we will be sending a recording of this webinar as well as the reports probably in the next 24 hours or so. All right, well, let's get started. I'm excited to be joined by two of my colleagues, co-CEO Bill Green and our REIT CFO Eric Stamp. For a rough outline, we're going to break up this presentation into three categories. First, we're going to talk about the general state of the markets and outlook as it pertains to workforce housing in the Carolinas and maybe some macro themes. We'll touch on the performance of the REIT, and lastly, we'll preview to you two investment offerings that we have live in the market. And if you have any questions, just want to remind everyone that please drop them in the chat box below under the Q&A button, and we'll get to them at the end of this discussion. So with that, I'll turn it over to Bill. The floor is yours.
Thank you, Rana. Thank you everyone for being here today. This is a theme we've talked about in the last few calls, and we just really wanted to summarize where we think the market is, but more importantly, where we think it's going right now. 2025 was a year where we really saw the supply kind of come to the end on its reset of upsizing. Uh, for 2025 in North Carolina, there's approximately 35,000 apartments delivered, a much smaller number in South Carolina. And because of our concentration in North Carolina, most of my comments will be about North Carolina. Um, but to give you a sense, in 2020 and 2021, that number was around 25,000. And prior to that, it was closer to 20,000 for an extended period of time. And so, we had, almost a 50% increase in deliveries that culminated in late 24 and late 25. Uh, for 2026, and particularly 2027, that's going to revert to less than 30,000 in 2026. And at the current pace, probably less than 25,000, maybe even less than that in 2027. So it's going to grind back to its historic norm. But with it, what's interesting is absorption is actually recovering. 2025 is so even though we had this incredible surge in deliveries of new apartments, 2025 is the first time that Charlotte saw absorption exceed supply since 2021. Raleigh and Triad also saw recovery, but they'd actually exceeded their recovery prior to that. Um, where the only place we actually are seeing challenges are in some small pockets, and then some suburban markets, where you can have total markets of only 5,000 apartments. And if you build, two communities of 500 or 600 apartments, you can destabilize something. And we're definitely seeing a little bit of that. We don't participate in a lot of those markets. But with it, what's really continuing is we have migration tailwinds. And this covers the period from 6/30/24 to 6/30/25. For North Carolina, you had 84,000 net in migrations off of $146,000 gross. And what's interesting there is during that period, international migrations dropped in half to only 46,000. So you had 100,000 domestic in migrations. South Carolina had 66,000 net in migrations. They don't provide reliable numbers from South Carolina. They're more random guesses from what I can figure out, but the net number is supported by the state. So a local economist, Mark Vittner, who worked for several large banks, indicated recently that 2025, 2026, same period, is improved so far. And so to give you everybody a sense of what that means is 146,000 residents moving in typically translates into about 60,000 households. And of that, usually around 30 to 40% of that goes to apartments. That number for apartment demand is probably higher now, but let's just say at 146,000, our constant number should be around 24,000 apartments of new development to actually absorb that. With it, we saw some of the same things happen. 2025 was actually an interesting year for us. In 2025, and Eric's going to go over this in better detail, but we'd really been really occupancy constrained in starting in early and really in late 2024 and into 2025, just because of the amount of supply. But we think that was also further exacerbated from ICE enforcement in early 2025, where we saw a 2% occupancy decline from May to July. And demographically, at least in our portfolio, that seems to support that properties that seem to have a higher migration and immigration population seem to actually disproportionately create some of that occupancy. Um, but that now appears to be correcting. Our occupancy from January 1 of 2026 to April 1 improved, and this is portfolio wide, improved 91.2% to 94.7%. And this is historically not a time of year where we're actually adding to our occupancy. This is usually a time of year where we're actually losing occupancy. We're never quite sure where the people go that time of year, but it just tends to probably be the cycle of apartments get delivered before the leasing season, and so they come online before there's the demand for it. But this is our highest occupancy since May of 2025, which is a great sign. Rent losses due to collections have continued to improve, and our operating expenses have also had moderation in really growth this year, and that was really led this year disproportionately from insurance premiums. But we saw most line items be in line or below our revenue growth, which is the first time that's happened in quite a while too. With it, we're finally seeing a pricing reset on the asset side. People, particularly who purchased apartments in 2021 to 2023, they've just run out of cash. They're all kind of making the same bet. There's hoping rates came down and they could afford to continue to roll and maybe have it all come back and have cap rates come into line. But we're just seeing the real capitulation. People with strong portfolios are not generally selling right now. But what we are seeing, and ourselves included, is you're starting to trim things on the edge where you're either in partnerships you can get out okay, or you're in partnerships where you've actually hit your business model and people just want their money back. And so we are seeing a little bit of that, but for the most part, we're focused on that first group of sellers, and those are the people who are stuck in having to really be forced liquidators. Uh, the next is capital markets, and I'm not going to lie, yeah, maybe I'm always a little bit more optimistic on rates. But right now, cap rates are, for stabilized assets, they're firmly in the 5 to 5.5%. Good assets, we sold two last year that at the time we sold, the day we went to contract, they're trailing 12. The day we went to contract was sub 5 cap rates. Um, but we think it's probably closer to 5.25 to 5.5 for stabilized things, similar to our portfolio. But a lot of what we're seeing in the market right now is actually still sub 90% occupancy. You have distressed sellers who can't pay, and it doesn't make sense for them to keep investing in their assets, so that by the time they go to sell, you're less than 90% occupied. And in those cases, if you just make the assumption you can get back to being leased, you're really seeing those distressed assets trade in the 6 to 6.5% range, and that's really where we're focused. Um, with that, in either of these cases, with interest rates where they are currently, and who knows what tomorrow brings, but pricing in the war and where we are today, these levels really work for us to continue to acquire. And so our desire to grow, as we've stated all year and really started to state last year, continues to be way better than lukewarm. It's pretty enthusiastic, and I would say it's probably getting close to 2014 levels where we probably should have started to think in terms of buying everything. With that, Rana, or rather Eric, I'll turn it over to you.
Yeah, thanks, Bill. Bill alluded to some of our performance, but for 2025, our operating performance, we had a relatively solid year. We grew our top line by 6%, which there's a little bit of volatility with our occupancy, with given the supply that Bill mentioned. But from a top line perspective, it was a pretty strong year, especially on our collections perspective. We really improved collections, modest rental growth, and a lot of this, top line growth was related to more occupancy and improving rent collections. From an expense standpoint, we really had some containment in our operating expenses. We saw some insurance costs, but the industry is kind of seeing decline, which we expect to see further decline. So there's some excitement moving forward. And then our turnover costs later in the, especially in the second half of the year, we saw quite a bit of improvement in our turnover expenses, and especially keeping renewals. So from an operating perspective, we had a great year, over 7% year-over-year NOI growth. Um, and then from a capital markets perspective, it was a very transitional year for the REIT. When we look at this earnings table here, this represents directly what is proportionally owned by the REIT. This is how we view um, our financials. It's how we look at this. It all reconciles to, our GAAP net income when we look at this sheet. But, our total portfolio is 7,500 units. You can see here on this sheet, we're representing 3,400 units, which is, 1,800 units that we directly 100% wholly own. And then there's 5,500 units in the portfolio that are owned through joint ventures, and we own anywhere from 10 to 25% of those units. So it equates to about 3,400 units, minimal change year over year, despite the capital markets activity that we had in 2025. We acquired for the first time since almost the beginning of 2023, 1,200 units, which is by far the largest Ginkgo REITs acquired since its inception. We disposed of about 450 units, and those were larger ownership units. So when we look at what actually happened from our acquisition dispositions, it was kind of a neutral change in our unit count, but it was a reallocation of units from wholly owned into more joint venture, where we're the REIT is the general partner. There's potential upside through our promote economics, more value add opportunities, and assets that we really liked. So from a capital market standpoint, by far the busiest Ginkgo REIT has been in multiple years, from both acquisitions and our debt side. On our debt side, we refinanced over a third of the portfolio, which is $200 million in debt activity, which a lot of it related to joint venture assets that were acquired during 2021 to 2023. They had short-term variable rate debt. Especially a lot of those assets had large value-add construction capital plans. So 2025 was a year of maturities, which we were correcting a lot of our debt. And with that, we refinanced $200 million. Majority of it was variable rate to fixed rate debt, which is much longer, 5 to 10-year loan terms, at majority around 5% or sub 5%. So from both the acquisitions and financing side, our capital markets team is very busy this year with all the activity they had. So from a bottom line perspective, or where you see earnings, there was a slight decrease in our earnings per unit, and a majority, if not all of it, is attributable to our temporary increase in interest expense. As those $200 million in refinance activity happening during the year, there was burn off of hedging instruments and cap rates, interest rate caps that matured during the year. So it was just a timing issue. Looking forward, it's actually exciting. We're up below a 5% all in interest rate for the REITs, like 4.92%, over 20 basis points better than we were in 2025. So as we move into 2026, we actually expect to see quite a bit of improvement on our interest expense, which will just continue to hit our bottom line. So from an all-in perspective in 2026, we expect better interest expense results, which will just increase our bottom line. From a top line and expense control perspective in 2026, as Bill mentioned, we had some decline in occupancy at the latter end of 2025. We were right around 91.5, 92% occupancy, but we've already seen, again, 3 to almost 4 points of improvement already in the first half of Q1. So we're projecting modest rental growth, not a lot, very limited rental growth in this supply market, but we are expecting to increase our occupancy, which we think we can pick up a couple points there, and continue to work on our expenses as we see some decline in insurance cost and turnover. So looking at 2026, we're looking for an exciting year, and we expect all of the capital markets activity that we had in 2025 to translate into results in 2026. That's from an earnings perspective. On the next slide, when we look at NAV, again, our board looks at NAV quarterly. So we, again, get a sub portion of the portfolio appraised each quarter, and our board reviews quarterly during the board meeting. We just had our board meeting about a month ago at this point. The board maintained the share price at 136. So the share price throughout 2025 maintained at 136. And that was with some volatility in our capital markets, both internally for us with all of the acquisition and refinance activity we had, but also externally as interest rates were dropping, but there was still very limited transactional activity taking place for the first 3 quarters of 2025. So, both of, cap rates kind of staying basically on par with where we were seeing in 2024 until we saw some drop in cap rates in late Q4 of 2025 after some of that transactional activity hit the market. We saw our appraiser adjust cap rates to a lower end of 5 to 5.25. But for the most part, cap rates stayed in place around that 5.35% throughout the year. So our NAV stayed consistently at 136 with support of the strong cash flows we had on the property level side of close to 8% growth year over year. So from a NAV stability standpoint, it was the majority related to modest changes in cap rates, but more directionally change in an increase in cash flows. But again, for the appraisals that we saw come in during Q4, we did see our appraisal adjust cap rates downward as we saw more transactional activity in Q4 hit the market. I think there was a little bit of a lag response from our appraiser, but we are seeing more downward movement in cap rates, which just provides potential better upside for the REIT, especially as we have now, over the course of the last couple of years, really transitioned to more GP oriented or general partner interest, where the majority of our assets and units are held in joint ventures. Almost 75% of our units now are held in joint ventures. So any downward movement in cap rates directly will respond to appreciation for the REIT just with our promote economics in the majority of those joint ventures. So not only do we have the upside of any asset level appreciation, we also have the upside of Ginkgo REIT shareholders have the upside from those promote economics. So with that, and again, our share price maintained at 136, operating cash flows, were strong and represented a no change to our dividend. So again, our dividend per share also maintained at $7.56 a share throughout 2025, which represents about a 5.6% yield. And since all of our dividends this year, or actually since inception, were 100% return of capital, that yield actually represents a little bit north of 9% when you compare that to a taxable investment. So you'll have seen on your 1099 that all of our shareholders received this year that those dividends were 100% return of capital and tax deferred. So that's from a NAV perspective. The bottom of the slide, we think we have an exciting opportunity that we're hoping to launch within the next couple of weeks. This is still subject to board approval, but this is kind of like a sneak peek or what we're expecting to be able to launch. As Bill mentioned, there's a lot of buying opportunity that we see in the market, and Rada will go into that in the next couple of slides of what those offerings look like. But we think this could be an exciting opportunity to help provide capital for those buying opportunities, but also providing a potential upside to our investors at buying REIT shares at a discount. Currently we have it projected at potentially an 8% discount to NAV, which we're buying shares at 125 compared to our 136 share, and then a potential DRIP reinvestment program also at a discount. Which when we take a look at this, there's very minimal dilution to the amount of upside we see with the capital that we could acquire some of these acquisitions that we're seeing in the market. Less than 1% all in to current shareholders of dilution, both, if we do both of these programs at the same time, less than 1%. So any current shareholder with, increasing their position by just 5% at this discount would be above any dilution impact to their current position. And then lastly on that is its potential for cleanup of some of our, legacy Ginkgo affiliated JVs that have investors in there. A lot of them are looking for opportunities to contribute to the REIT just for getting out on these single syndicated level assets, but more into more diversified set of assets. So there'd be opportunity to clean up some of the balance sheet at our single level JVs, which could be, really beneficial for the REIT to have wholly own all of those assets. So it is exciting. Again, hopefully we're looking to send this out in the next week or two, as but the board still needs to take full look at this and review. But this is potentially upcoming. So but that's what I have. So I'll pass it over to Rada to discuss some of our offerings.
Great, thanks, Eric. Yeah, so for our offerings, we'll just touch on redemptions, and just to remind everyone, if you have any questions, just drop them in the chat bot on the bottom of the screen. Yeah, we'll touch on redemptions as it relates to Ginkgo REIT, but maybe it would help just to highlight a couple themes within the alternative investment space as it relates to redemptions and the queues. It's hard to go a couple days without picking up the paper and seeing many of the large alternative asset managers have built redemption queues in quite a short amount of time. I mean, you've seen Blue Owl, Cliffwater, Apollo, you name it. They have built pretty significant redemption queues in a short amount of time. Some of the themes that surround these individuals, and we were just at two conferences that highlighted some of this, and they are not specific to Ginkgo. Many of these companies, alternative asset managers, are in the private credit and BDC space, which raise a significant amount of capital in the last 2 or 3 years. And as many of you know, when you raise capital, you have to deploy it. Your hand is sort of forced, and I'm not speaking for the entire industry, but some of these covenants might have been a little light. At the conference that we attended, PIK interest was highlighted, where one BDC's peaked at 25% PIK interest. So that's not current pay interest, which is kind of concerning. And it sounds like from many of these BDCs and private credit platforms, many of them were chasing the same deals, which were SaaS software solutions, which have been beaten up pretty significantly over the last couple months due to AI disrupting the industry. So again, these are just sort of the macro backdrops against some of these redemption queues. With Ginkgo, our redemption queue is rather de minimis currently. Back in 2024, we had a large investor that requested a redemption. We filled half of it immediately, and then we've been chopping away at it ever since. Now, we currently have less than 1% of shares outstanding of common shares that are in the queue. If you can do the rough math here, we would probably clear that queue in 2 to 3 quarters. And that again is the common share side or the left-hand side of the chart. On the right-hand side, the OP units, which is a pretty meaningful part of our shareholder base, that queue is completely empty. So, against the backdrop of some, pretty scary headlines, obviously we're not immune to redemptions, but it's very manageable. All right. Now moving on to the transaction side, I'm going to share two opportunities here. The first of which is Edgewater Apartments. It is in the Greensboro market. And as you all already know, we have a strong presence in the Greensboro market. We currently own and manage 3,000 apartment units in this area. So when we are underwriting these deals, as with most Ginkgo deals, we're not, looking, well, obviously we're back testing this with CoStar data, but we're actually using numbers that are relevant to assets that we already own. And with this asset, it's a theme that we've encountered before. It's an out-of-state landlord. They've struggled with the asset. They've actually relocated one of their asset managers to live at the property to improve it. They've actually done a really great job of stabilizing the asset. They poured almost $13 million into the asset. So the asset is in very good shape. The bones are really good. And what we like about the investment outside of the location is really we're coming in at a very attractive basis here at 42% discount to replacement costs. And this will be a very nice bolt-on acquisition to our existing portfolio in the region at 483 units. Total capitalization of the transaction is 47%, $47 million. The leverage is 67%. So it is, I would say, a pretty conservative levered deal. The deal pencils at a 24% IRR and a 2.5 multiple. And we'll have, I don't know, I'm throwing a lot of numbers out there, but we'll have all this hosted on Ginkgo Vest probably in the next 24, 48 hours as we're just finalizing the sub docs. And from a business strategy standpoint and from a CapEx standpoint, our plan is to put another $7 million in the property over the course of the whole period. And that's to be used to improve the exterior of the asset as well as the interior and sort of rebrand and elevate the community. Currently, it's at 92% occupied, and we're bullish on the Greensboro markets. It's actually, to Bill's point on supply, it's one of the few markets in the Carolinas that hasn't seen a ton of supply and has had some supply, but not nearly as much as, Charlotte, for example. And this property sits about 2 miles from the Piedmont Triad Airport. So you've got a great employment market. FedEx and Honda Jets are bringing a lot of jobs in the area. And there's a lot of other companies that are building campuses there. The asset is a 1974 asset, but it's been pretty extensively renovated in 2024. So again, there's been a lot of improvements in the property currently, and from a timing perspective, we have a short fuse here. We are hard on contracts. We should have the PPM and subdocs probably within the next 24 hours here. So that'll be hosted on Ginkgo Vest. We're asking for docs to be signed and funded by April 23rd. The minimum here for a direct deal traditionally is $50,000. You can, in the interim, indicate interest by either reaching out to myself, Kevin, or Bill via email or call us. But we are taking orders as we speak. And actually, I just want to highlight the equity requirement for this transaction is roughly $7 million. Okay. Next up, we're going to highlight the GP Fund 2. We're calling this the second iteration of the GP Fund 1. So we're replicating a lot of the same terms as the Ginkgo 2018 Impact Fund 1, which many of you have been part of. And if you've been part of that, you would know that the fund has not completely liquidated at this point, but to date, the fund has returned roughly a 35% IRR and a 4.0 multiple for Class A members, which is, a very strong return. The thesis is similar to the predecessor fund, and it's going to be workforce housing in the Carolinas. The main differentiator here between Ginkgo Fund 2 and Ginkgo REIT is this is actually going to be a closed-end fund. So it'll be a 5-year term with three 1-year extensions. And as most GP funds are traditionally structured, you get sort of the asymmetric upside with the linear downside. Ginkgo REIT will be investing alongside Ginkgo Fund, the GP Fund 2 on joint ventures going forward. The targeted return on these investments, from a conservative standpoint, we're targeting north of a 15% deal level IRR. When you add in the promote, that sort of we'll start to see a 20% handle from the promotes. In terms of the amount of assets that we're targeting, depending on the amount of equity that will be committed, we're targeting 8 to 15 um, communities in the fund. So that is sort of the structural makeup of the GP fund. Bill alluded to some of these points earlier, but I think the biggest question is why now? And just to kind of echo some of Bill's um, themes, I mean, we're starting to see some distress in the market, particularly from folks that bought in 2022 and 2023, which, as many of you know, we sort of sat on our hands during this period of time. We just didn't see a lot of great opportunities in the market. The second reason why we're seeking to raise the GP fund is, there's been a lot of oversupply in the market, as Bill alluded to, is 26,000 units that hit, the Charlotte MSA in sort of from mid 2024 to mid 2025. Serendipitously, a lot of that has been absorbed, but in some fringe markets, that's not the case. And last of which, some of these funds that raise for a closed-end fund are sort of sunsetting. So there are opportunities for us to pounce on assets that just need to be liquidated. So therefore, we are active buyers, and we're seeing more opportunities to capitalize deals. From a timing perspective here, it is the same as Edgewater, largely because Edgewater will be the first seed asset in the GP fund. So if you want, direct allocation and 100% allocation to the Edgewater deal, you can participate in our sidecar. If you want, a piece with outside economics, and more diversified closed-end investment, then the GP fund is probably more suitable for you. Similarly, from the timing perspective, docs will be ready likely in the next 24, 48 hours. We'll host that on Ginkgo Vest where you can on your own time review those, indicate interest, and then we can follow up with the DocuSigns, et cetera. But in the event that you want to get in early or want to indicate interest to save a spot, you can obviously again email myself, Bill, or Kevin. And yeah, hopefully that helps set the stage for these next two deals that should be on Ginkgo Fest in the next day or two here. So that concludes the two deals. I don't know, Bill, if I missed anything on these two offerings, or if you want to fill in any gaps here, and then we can move into the Q&A here.
No, thank you, Rada. I think everybody touched on the relevant things. The first question is why now, but then the other question is why are we doing these alternative capital raises? Well, the real fact is if we could raise this money directly in the REIT, we would. It's a very challenging market based on some of the issues that we're now seeing crossing over in the BDC debt space, where people are just sort of shutting down to permanent vehicles with your own periodic liquidity that could be subject to gate. And so it's a very difficult for us to raise as much equity as we see the opportunity. And so therefore we see the opportunity much greater than the $12 million that we think we can raise in the REIT this year. We see it at probably closer to 25 million. So we do think that the GP fund is a great way to go. But when I look at this, I want to remember, um, and for those who don't know, I'll remind you, the people that work and operate at Ginkgo own almost 40% of the REIT. So we're very committed to the success of the REIT. So if you invest in the REIT, you're going to get a piece of all of these deals, whether you do anything or not. So if you're in the REIT, you get it no matter what. But what the GP fund does is it allows for you to now actually invest more directly into the general partnership interest in the fund format. But if you're in the REIT, you're going to get some of that. So to put in perspective, the REIT will own basically 10% of the fund, and that 10% of the fund will translates to about 1% of the equity. But if it goes successfully, that 1% of the REIT's equity will actually get a return similar to 4% of what we think the expected return is for the regular interest in the REIT. So it's very compelling. Obviously, if you're in the GP fund, Rada went through some of the economics there. But then when you look at Edgewater is going to represent approximately 6% of the investments. So Edgewater looks to us as a very solid underwritten deal, probably one of our top five deals from an IRR perspective since we've been doing this in our upfront modeling. But it will represent about 6% of the investment of the GP REIT. If you invest into the deal directly, you obviously put 100% into the transaction. And so for us, we think we give people the opportunity to invest in a lot of different ways, and that's what we're trying to do. We're trying to align with how you want to invest with what the opportunities we see, and we're indifferent. If you don't want to invest with us, we get that. But if you do want to invest with us, we want to give you something that can line up with your risk appetite.
Great. Thanks, Bill. Thanks for filling in some of the gaps there. So just a reminder, everyone, please drop any questions you have in the Q&A section. And I guess while the questions start coming in, there's been actually one or two common themes with some of the investors that Kevin and I have been on the phones with of late. And Bill, you kind of touched on this, the war and spiking gas prices. I'm just curious, from a hierarchy perspective, in terms of filling up, your gas tank or paying your rent. I know there's generally a lag here, but are we seeing any bad debt collection spike? Are we seeing any rippling within construction costs? Maybe if you can opine on that.
It's pretty early to say. I don't know that we are, and I don't know that we're not. What I can say is that coming into this, we'd had really nice cost containment for the better part of 12 to 18 months. Um, I'm not sure how disruptive petroleum is to our total supply chain. I always know that petroleum is in more products than we think about. We think of it as just our car, but it's not. And I think it's too early to say. We're not doing as much construction right now in this market as we have in the past. So we're not really doing as much in the way of physical buying. Put it in perspective, 3 years ago, we were spending $30 million plus a year in renovation, apartment rehab, et cetera. A lot more of those dollars now are along the lines of maintenance and really exterior improvements. And so our capital spend is down to 10 to 15 million a year. And so the impact on that will be probably less total dollars no matter how we do it. But for right now, I don't really have a good enough sense.
Got it. Well,
The only
thanks
thing
for
I'll add to
that.
that is, um, as Bill sort of mentioned, from a collection standpoint, again, it probably is too early to tell. There could be a lag effect here, but just to speak on what we've seen in the first quarter, for the first 3 months, again, we've seen almost an increase in 3 points in occupancy. But on the opposite of that is our rent collections for the first 3 months have been the best we've seen in almost 2 years. In March, particularly this last month, was our best rent collection month since since I think June of 2023. So from a collection standpoint, we haven't seen anything yet. That doesn't mean it's not to come. If there is a long-term effect or there's a lag effect here on that, but for the first quarter, for the REITs assets, it's been a pretty compelling quarter.
Great. Thanks, Eric. I guess the other question here is, I think it's May in which the Fed chair will um, be a little rotation or changing of the guard. Do we see any impact on sort of agency financing or you know, obviously we don't have a crystal ball, but where rates may go with sort of a changing of the guard, or too early to tell on that front too?
I am not nearly equipped or smart enough to be able to guess what to do with that. I think you try to. I think the way we balance our book is two ways. One, and we have very favorable financing at the project level, and as a result, our debt maturities are very, very well staggered. Now, while Eric didn't provide that data today, he has in the past, and we don't have any pending debt maturities of any size or scale really for at least 3 years and generally 5 years or more. Eric and team have spent the better part of the last 18 months extending a lot of that duration at surprisingly attractive rates. In the context of doing that, we as a portfolio, I think we're still less than a 5% total rate on average for 5 years. Uh, but I'm going to stay away from the geopolitical side of that. I have no idea what's going to happen in May. It is, like everybody else, I just get popcorn and watch it.
Yeah. Okay.
From the current portfolio, they're just how longevity of our debt. Again, 80% of our debt now is now fixed with long term. Our weighted average maturity date is not till 2031. So we have quite a long runway for our current portfolio. Well, that may affect new acquisitions, of course, but from a current balance sheet perspective, again, we're at a less than a 5% all-in rate, including our Ginkgo notes program. Um, and again, we have majority fixed rate that has longevity to it.
Yeah, I want to talk maybe one more thing about inflation, Eric, and what you're saying makes a lot of sense. So as we put things in fixed rate, our assets obviously are not fixed income instruments. There's variability in them, but historically, we've had more than a 3% revenue increase per year. We budget to a 3%, but plus returns on capital. But I think we've averaged as a REIT, I think we've averaged closer to 7 or 8%, which is still way above where we model. We budget our expenses to roughly 2.5 to 3%. So basically, our margins we think stay the same over long periods of time. And what that does is if we lock in fixed rate debt and we have this recurring revenue, and then which translates to a recurring NOI increase, you have a fairly interesting phenomenon, and that is if our bottom line before debt service goes up 3% per year, but our debt is fixed, well, that all flows to the equity, and if we remain kind of 60% levered, you can assume that we've got two turns of leverage, which means that as this market starts to stabilize even at 3%, and our debt is fixed, we could see a continue, where we've had to refinance that the last few years, which has gone the other way. If our debt remains flat, we could actually see, 7 to 9% NOI or net cash flow after debt service increases going forward because we are locking in our liabilities, and historically we have seen revenue growth and bottom line growth of much greater than 3%. So I'm very cautiously optimistic about where our balance sheet is right now.
Hmm. Great. Thanks for that anecdote. Just seeing if there's any other questions here. I guess um Bill, and I'll share my insights, but I attended two conferences recently in Scottsdale and in Dallas, which were geared toward the alternative investment space. And I'll share my feedback, but I was curious, Bill, if you had any like key insights or something that stood out for me that was, sort of how robust the DST market was from a fundraising standpoint and how that compares to, some of the non-traded REIT fundraising stats. And, 2021 was sort of the high water mark from a non-traded REIT standpoint. 21 billion was raised. That has sort of been a downward decline. But it's starting to tick back up from the trough. In 2025, that was $5 billion. And the DST market sort of blew it out of the water with 8 billion raised in 2025, sort of outpacing the non-traded REIT space. So to me, that market seems rather robust. And um, maybe to preview, we are launching a DST for everyone's benefit, probably in the next, call it 45 days, to allow for 1031 exchangers to participate in an individual asset and defer the tax liabilities with the option on a future basis um, to contribute their equity interest in the REIT from a diversification standpoint. So, you know, you feel confident that that the trend will last, and you're kind of surprised that the fund inflows and sort of the size of the sponsors that are sort of chasing after this DST market. I don't know, Bill, if there was anything that stood out from the conference.
I think going into those conferences, we were both aware that the tax advantage capital raising had actually eclipsed the REIT fundraising over the last 2 years. Uh, at first by a little bit, but also by this last year by quite a bit. In fact, non-traded REIT fundraising was negative when you look at the redemptions and repurchases that took place. And what for me, what I think what was most eye-opening is it's a product that's really used to reach out to people that you wouldn't normally have access to, that you wouldn't normally know how to obtain that potential investor. And well, we have most of the people on this call, most of the people in the REIT, we have a personal relationship with. We have 400 plus investors. 250 of them are outside of the company. About 150 are related to shareholders and colleagues within the company. But and we have other partners. But what this is these are products that other players who haven't been able to build the network that we did with our individual friends have relied on the broker dealer network to raise their equity, but then also relied on that broker dealer network to distribute this product. And this really gives us an opportunity to effectively use this as a way to get introduced to large scale investors that we wouldn't normally see. And I would say that was the eye-opening part of it. I didn't really quite understand what that does for the potential diversification of the REIT, what that does to repatriate capital, and really give us scale at a point in time where, again, we would love the ability to redeploy that capital as well as we can.
Um, yeah, and for everyone's benefit, that was the FactRight due diligence conference, which we have FactRight reports on the sponsor as well as Ginkgo REIT as well. And the other one was the ADISA conference, which is an industry trade group with many sponsors participating in that. Um, with that being said, I'm not seeing any additional questions in the Q&A. So with that, just want to thank everyone that attended the webinar. As I mentioned, I'll send out a recording as well as recirculate Ginkgo REIT's 2025 audited year-end reports. Also want to thank our panelists, Eric Stamp and Bill Green. If you guys have any sort of final words or anything else to add.
Thank you very much for your time.